FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. It is April 25th, 2018. Well, we're seeing the unthinkable occur. We're seeing a 10-year over 3%. That wasn't supposed to happen. What will be the fallout from that? And we're seeing major market volatility. What's that all about? Here to discuss is our good friend Jeffrey Small. First, though, email us, be part of the show. The email address is kl@kerrylutz.com, and you can put comments on the website, or if you're listening on YouTube, just put them up on YouTube there. I look at everything. I know everything that's going on the site, and we will respond when appropriate. So, Jeff, welcome back to the show.
Hey, Kerry, thank you for having me back again. I love your show. It's one of the best shows to be on, to be honest with you, and you really helped me promote my book. My book really kicked butt this year on the launch of it on December 12th of this past December, so I appreciate all your help on that.
And tell us the name of the book again.
It's called Turning Financial Planning Right Side Up, and it's a book that's really designed for baby boomers to know where to invest for the next 10 to 15 years. Where's the Goldilocks zone? Because certainly as all of this volatility occurs right now, what's going on in the markets kind of hit the wall here, and they seem to be in a corrective mode.
Mm-hmm. Yes, they do. I'm not convinced of it yet, but certainly it's a stock picker's market, as they like to use that cliche. It's not like just buy the index and watch it go up, up, and away. Like I say, I'm not convinced that it's going lower over the long term, but surely for now, we are in this. Perhaps it's a consolidation phase.
Well, I think, we're at the end of an 18-year peak in the markets, Kerry, and I think that, in 2000, we had an 18-year peak. Stock buybacks are peaking right now like they did in 1999 and 2007. Interest rates are about the same place, and so there's lots of weird commonalities. And so, the market seems to run in cycles, and I think what's really happening right now, though, is the positive earnings news is really preventing the market from going through, a substantial correction. And so we've got kind of a buy the dips, sell the rips type market right now. You're exactly right. It's a stock picker's market.
Hey, and that means you can't just do formula investing. You really got to look at these stocks and really analyze their prospects, figure out why they might go up or why you should avoid them. But the 10-year going over 3%, that's a real bellwether, isn't it?
Well, it really is, and it's really putting the squeeze on corporate leverage, because corporate leverage it's higher than it was in 1999 for domestic stocks here in the United States, and so that's putting the kibosh on the markets, and that's rattling things. We've got $4 trillion of corporate debt, about $1.6 trillion of that is junk, and that could be very well where the seeds of the next financial crisis are planted if rates get to be too high. The undertone there, though, on that is, will it affect stock buybacks? And so we expect stock buybacks to peak this year and then tail off as rates rise. And what most consumers don't understand, and what we explain in the book quite extensively, is how stock buybacks have peppered and tenderized the market the last 8 or 9 years. And so we were on pace for $800 billion of stock buybacks. We've averaged about $50 billion a month since 2010. And so without those buys, Kerry, where would the stock market be today?
Yeah, that's a good question. 800 billion, but then you've got central banks buying stocks, the Swiss central bank, the Japanese central bank, who knows, maybe even the U.S. Fed is buying stocks. And, maybe it's just one factor. So if it declines 10 or 15%, 20%, is that going to be a big deal?
Well, 20% is technically a bare correction. It's a correction, so is it going to be a big deal? I think it's a big deal for folks if they want to manufacture income from their portfolio, if they've hit the peak of their retirement and they're now getting ready to transition out of the private sector into the retirement sector. And I think that makes a big difference for folks. You've really got to understand the effect of a downturn on your portfolio, because the objectives while you're accumulating and being growth-centric in the stock markets are entirely different. The money alignment is entirely different than when you retire. And so you've got to really take it to a higher mathematical level and say, what does a 20% downturn do to my portfolio? My book portrays all of that to the nth degree and teaches you how to do that. And these are things that folks don't get. If they're accumulation oriented and they're stuck in that mindset of we need to accumulate, which we were doing while we were working.
And what you're really describing is a demographic shift. And if I could go more deeply, you're talking about you're a baby boomer, 10,000 of you per day are retiring right now. I remember 20, 30 years ago when it was the greatest generation, 10,000 per day of them were retiring, and then X thousand go on to die every day, sadly so, but that's just the way it works. So it's really a lot about demographics, isn't it?
Man, Kerry, you just hit it out of the park. You're exactly right about that. Demographics are undermining the European markets. They've destroyed the Japanese stock market. And now our population, half of it here in the domestically is over 45, half of it. And so when you have people that are over 45, what happens? Well, you pay down debt, you don't spend as much, and you save more. And so you can't have consumerism, which drives demand for products and consumer services and inflation. And so where is the inflation going to come from? How are they going to grow the economy in a shrinking economic environment? And that's going to be difficult to do going forward. And that's also another drag on the stock market, and so there's lots of undercurrents that are dragging the stock market to where we are today. Demographically, it peaks in about 3 to 4 years when we see that big kaboom. But not to plug the book again, but we go over the demographic components of all of the aforementioned that I've discussed here recently in the book as well. So it's a really good snapshot of how that will impact the markets as well.
And we've seen these shifts occur. Unfortunately, Gen X, which followed the baby boomer generation, much smaller. We don't get to a larger generation again until we hit the millennials, and that's not for quite a while. And they got no money, and they got tons of student loan debt and everything else. And they want to be different, and they're not thinking so much of investing. I mean, obviously, the ones in the upper middle class are. I will tell you, like, my kids are all investing away in their 401ks and whatever else is available. But those people are getting hit by the new tax law as well, because the reduction in state and local taxes. So there's definitely some bumps in the road there.
Yeah, there are some bumps in the road. I don't think we can count on the millennials to bail us out demographically. They will not have the same amount of children that the baby boomers did, and we'll still be on that same long-term secular downtrend in population growth, which will ultimately, for them, when they get to be, Generation Xers or retirees in the baby boom cycles, it's going to be a weird time. I don't know. I don't know what the markets are going to look like at that point, Kerry. It's going to be real ugly.
Well, one thing, we do see, though, is the market. Look, they've been almost 150, 160 years, Dow Jones. Stock trading's been going on for 400 years. So the markets keep trading regardless what happens. And there's ups and there's downs, regardless how good the underlying economy might look. I mean, look at now. Who would think that the market could keep going on when the fundamental economy, Main Street as it's called, has been really in the dumps until the past year?
That's correct. We've had the second best stock market run-up in history in the last 8 years and the weakest economic recovery in history. And so, we would call that in English class in high school an oxymoron.
Yeah. Well, definitely a non sequitur at the very least. So what's the answer here? If the market is trading independently of the underlying economy, what does that tell you for the long run, for the future?
Well, that tells you that we're in a bubble. And so we call this the everything bubble because the market's been peppered to increase by way of having next to nothing in interest rate charges, 0% almost for the majority of that time. So companies have leveraged out, bought back their own stocks. The Fed got us out of the downturn from 08 and 09 by purchasing $4.2 trillion of treasuries and mortgage-backed securities, and now they're deleveraging and quantitative tightening. And so they're doing the opposite. And so when they've done this historically, like in the 30s, when we started to deleverage again from the Fed and we raised rates at the same time, it caused another 60% correction in the market. So oddly, there is a paradigm that's very similar to the 1930s debt cycle that we're going through today. And so the only thing that can save us right now is corporate earnings and maybe the Fed not raising rates. But they've, they took a chapter, Kerry, out of the 2000s with what they did with real estate. They did the exact same thing to the stock market to lift up asset prices. They just reinflated the debt bubble again. So here we are again.
Yeah, here we are again, and there's other parallels to the 30s. For instance, lifting of the cannabis prohibition. It's FDR ran on a platform of happy days are here again, and he wasn't just talking about the economy, he's talking about the ability to buy liquor again legally. And now we've got the cannabis prohibition ending. A lot of parallels between now and the 30s, isn't there?
There was. The rise of nationalism was very popular. We were in a civil war as well, like we are today politically. We are in a civil war at the top levels of government down to the college students and the elements of free speech that are being, reduced down to, hey, you can't say that. That offends me. So yeah. I don't know if that went on in the 30s, but the rise of nationalism was definitely there.
Yeah, for sure. For sure. So, what is a baby boomer to do here? Jeff, what do you do?
Well, I think, they have to broaden their horizon and say, look, there's 100 million investors that are long in the stock market today. I don't want to be one of them. And so cash is king, or they mobilize their portfolio to reflect a fixed income model, and they find a boutique firm that will buy individual components that will not outsource to mutual funds or private money managers. And so what I mean by that is they become yield-centric. They buy things like preferred stocks, corporate bonds, maybe a couple of good BDCs. REITs I wouldn't touch until the interest rate thing subsides. And so those are the types of things that we can look at to generate an income stream and being as market neutral and uncorrelated to the major market indexes as possible at this point in time. Now, we have that chapter in my book called The Goldilocks Zone that goes over all of that and more, but I think the Goldilocks Zone for the retiree, baby boomer type folks is going to be in that fixed income category, Kerry. And I think that the reality is, even though we're in a rising rate environment, we have to buy the highest quality, highest yielding, and dividend-paying components that we can find, because if we can do that, we're going to minimize any kind of erosion that would occur at asset prices when rates creep up here. And rates are going to keep creeping, but then they're going to hit a point where they can't creep up anymore. And so I see 3 or 4 more moves at 0.25%, which isn't that much, but it'll be enough to spook the stock market.
Yeah, which it appears to be now, for sure. So we have to look at cash flow, not capital appreciation. In a lot of ways, that's always a good strategy because you never know when the market's going to take off. You never know when it hits this irrational exuberance, and then you find yourself with these big gains and you don't know what to do with them. It used to be you could throw them into resource stocks, into oil, gas producers, distributors, et cetera, MLPs, master limited partnerships, but they got slaughtered a few years ago when the price of hydrocarbons skidded and we had a major crash in that sector. Now they've been heading back up. Is that going to stay, or are they suitable yet? Where are we with those types of stocks? They always paid higher dividends.
Well, It depends. If investors see that as a value play and to avoid volatility, we'll see a flight to that type of stuff. When the markets seem to get on shaky, and it's not a trader's market, which we're obviously in today, the buy the dip, sell the rips. When the markets get really shaky, people will fly into what they consider the most value-oriented common stocks they can find and not understand that there's other components they could purchase that are not in the common stock realm that provide more safety and stability and give you a much better yield or dividend or interest rate. And so I think that's where the undercurrent of the financial culture has missed the boat. And they missed the boat intentionally for that. That's why you have to work with somebody like us, or you've got to find somebody that in your locale that can work with that will buy those components to keep you insulated from market downturns.
Yeah, makes total sense. And so it's not a cookie cutter approach to investing any longer, right? You got to really be on the ball and really have a strategy, because no strategy is worse than not having any strategy at all. So, all right, Jeff, well, tell us again where we find you at and how we get your book.
Well, the best place for the book is the website for the book, and it's called financialplanningrightsiteup.com. You can read a few pages. There's a couple of my video appearances on CNBC, and there's direct links to Amazon on the book there as well. So that's where I would suggest. And if you want to contact me as well, there's a contact button on that website as well for me.
All right. Excellent. Hey, and as always, be part of the show. Participate. Email us, kl@kerrylutz.com. Love getting your emails, seeing them in my inbox in the morning, and the Twitter feed's at Kerry Lutz, the Facebook page for now, Financial Survival Network. Jeff, always great talking to you. We will talk to you again real soon.
Thank you, Kerry. You take care.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.